Yeah, welcome to my channel. So we are going to be introducing topic theory, auditing, which is audit planning, and then risk assessment. So we are going to see how an audit is planned for and how risks in an organization are assessed. So we are going to start by looking at audit risk and its components. So we shall start by defining what an audit risk is. So audit risk is the risk that the auditor gives an inappropriate audit opinion when financial statements are materially misstated, like the auditor gives a wrong opinion when financial statements are materially misstated. So there is that risk that the auditor may examine the books of accounts and all that, and they still give an inappropriate opinion, and that is what we call the audit risk. So audit risks relate to material misstatements in financial position. An example can be when a company, the expense may be 10M on repairing a plant during the year, but instead of recording that money that was spent on repair as an expense, they record it as if they bought an asset. They record it as an non-current asset, so that can result into the auditor giving an inappropriate opinion, even when financial statements are materially misstated. So that can be an example of an audit risk. Audit risk is a function of the risk of material misstatement and then detection risk. We shall look at detection risk as we go further. Then the risk of material misstatements, like there being a possibility that financial statements are materially misstated. The risk of material misstatements arise from inherent risk and then control risk. Inherent risk and control, we are going to look at all these like in details as we go on. So material misstatements may not be detected during an audit due to the detection risk. So the elements of an audit risk are three. We have the inherent risk, we have the control risk, and then we have the detection risk. We are going to look at the definitions in the next video. So in an audit risk model, like what leads to an audit risk, we get the inherent risk, we multiply it with the control risk, then we multiply it with the detection risk, and those three can lead to an auditor giving an inappropriate opinion when financial statements are materially misstated. So ISA 200 states that an auditor must plan and perform the audit with an attitude of professional skepticism due to the risk of material misstatements. An auditor must plan and perform an audit with an attitude of professional skepticism. Professional skepticism, we mean that an auditor should perform an audit when they have a questioning mind. Like they question everything that they see. They do not trust anything. They do not trust anybody. They must perform the audit with a questioning mind and then be alert to conditions that may indicate any possible misstatement, because they can be due to error or due to fraud. Then they should obtain persuasive audit evidence. So that's what we call acting with the attitude of professional skepticism, have a questioning mind, and then be alert to conditions, and also make critical assessments of audit evidence.